In the world of finance, there's a silent force that moves markets without ever being seen. A force that can make investors rich, bring industries to their knees, and change the direction of global economies overnight. Most people never notice it. They never feel it. But behind every stock price, every market boom, every sudden crash, it is there quiet, powerful, and constantly shifting. This force is the value of the US dollar. Strong or weak, rising or falling, every movement sends ripples through the stock market, shaping the destiny of countries, companies, and ordinary investors. And yet, the real question remains: what does it truly mean? To understand this, we have to step back, far back, to a time when the modern financial world was still forming. For generations, money was simply metal, gold, silver, copper. Nations trusted what they could hold, but everything changed the moment the world decided to trust something else, paper-backed, not by metal, but by belief. And at the center of this evolution stood the US dollar, a currency that would eventually become the heartbeat of global trade. It began slowly, like all revolutions. The world had emerged from war, economies were fractured, and nations were desperate for stability. The dollar, backed by the largest industrial engine on earth, became more than just currency. It became a symbol of trust. Over time, as the United States grew in economic and political power, the dollar transformed from a national currency into the world's currency. A quiet empire built not on land or armies, but on money. But here's the truth: the world rarely discusses. Every currency is a weapon, and the strength or weakness of that weapon can determine whether markets rise in euphoria or fall into chaos. When the dollar grows stronger, it behaves like a magnet, pulling global capital toward the US, tightening financial conditions everywhere else, and putting pressure on countries tied to dollar debt. And when the dollar weakens, the opposite happens. Money leaves the US, investors rush to emerging markets, and commodities explode in value. The stock market, fragile and sensitive, responds to every shift. Yet this dynamic did not appear overnight. It was shaped through crises, wars, political decisions, and moments of panic that reveal how deeply the dollar controls the world economy. Consider one such moment. It was the early 1980s. Inflation in the United States was out of control. Prices were rising so fast that ordinary families felt like they were losing ground every month. Something had to be done. Then came Paul Volcker, the chairman of the Federal Reserve, a man willing to make the most unpopular decision in modern economic history. He raised interest rates to shocking levels, rates that today seem impossible. The world held its breath. Borrowing collapsed. Businesses suffered, but the dollar soared, becoming stronger than ever. Investors rushed toward US assets, desperate for high yields. Stock markets first trembled and then recovered as inflation fell. That was the first major demonstration of a rule still true today. A strong dollar can crush inflation, but it can also crush markets that rely on cheap money. Fast forward to the late 1990s. The dollar surged again, this time triggering a series of catastrophic events across Asia. Countries that had borrowed in dollars suddenly found their debt exploding in cost. Markets crashed, some governments fell, factories closed. Entire middle classes were wiped out in months. And yet, on the other side of the world, Wall Street roared. US stocks boomed, tech companies soared to unbelievable heights. The same force that crushed Asia was fueling American wealth. A reminder that the dollar's strength is rarely neutral. Someone always pays the price. But history has a sense of irony, because just a decade later, in 2008, the world experienced the opposite. A crisis born inside the United States, inside its own housing market, its own bank spread like a virus across the globe. Markets collapsed. Confidence evaporated. And as panic spread, investors rushed towards safety. Not gold, not oil, not real estate. They rushed toward the dollar. The same dollar at the center of the crisis. Its value surged. US stocks crashed, but foreign markets crashed even harder. Once again, the dollar showed its paradox. Even in America's darkest moments, it becomes the world's safe haven. But the story does not end in crisis. Because after every collapse comes a recovery, and each recovery reveals how a weak dollar can ignite a completely different kind of financial transformation. When the dollar weakens, everything changes. Commodities rise. Oil becomes more expensive. Gold shines brighter. Companies that earn money overseas suddenly report bigger profits. Tech stocks surge. Investors feel bolder. Risk becomes attractive. The market breathes differently, freer, faster, more optimistic. Take the period after the 2008 crash. The dollar weakened sharply. Cheap money flowed across the world. US companies borrowed billions at near zero rates. Investors poured money into stocks, pushing the market into one of the longest bull runs in history. Apple, Amazon, Tesla giants were born, fueled by a financial environment that rewarded innovation and punished hesitation. The weak dollar made risk-taking profitable, and the world followed. So the next time you look at the stock market, remember the silent force moving beneath the surface. It's not just about companies, earnings, or news. It's about the dollar. Have you ever wondered why markets never seem to move in a straight line? There's always a twist, isn't there? A sudden reversal that catches everyone off guard. Think back to 2022. Inflation was roaring back across the globe, and the Federal Reserve hit the brakes with rapid rate hikes. Almost overnight, the US dollar surged to its strongest level in decades. The impact was immediate. Emerging markets stumbled. European currencies weakened. The Japanese yen collapsed to levels we hadn't seen in a generation, and the US stock market, after years of soaring, was hit with a harsh dose of reality. Those once-cent stoppable tech stocks plunged. Companies that had relied on cheap borrowing suddenly faced immense pressure. It was a painful reminder of a simple truth. A strong dollar is great for some, but it can be incredibly dangerous for many others. But here's the thing. Behind all these rises and falls, there's a deeper mystery, one that's often overlooked but is crucial to understanding the market. The dollar isn't just driven by economic data. It's driven by fear, by psychology, by raw human emotion. When investors feel confident, they take risks. They sell dollars to buy stocks, commodities, and foreign currencies. But when fear creeps in, when uncertainty spreads like wildfire, they rush back to the dollar like survivors clinging to a lifeboat in a storm. The dollar moves not just with numbers, but with human behavior, with hope, and with fear. This constant dance between confidence and panic, between strength and weakness, is what truly shapes the stock market. So, let's break it down. A strong dollar means imports get cheaper, which helps cool down inflation, and American consumers feel some relief at the checkout. But it's a double-edged sword. Multinational companies see their overseas profits shrink when converted back to dollars, which hurts their stock performance. Investors start pulling money out of riskier assets. Growth slows down, and the entire market becomes more cautious. On the flip side, a weak dollar can be a huge boost. Exports surge because American goods become cheaper for the rest of the world. Companies earn more from their international sales, and stock prices often climb as a result. But this also brings the risk of inflation, higher prices for everyday goods, and more expensive commodities. Investors start taking bigger risks, and while markets can rise quickly, they can also fall just as fast. So, what does this all mean for your portfolio? The answer is both simple and complicated. A strong dollar offers stability, but often limits growth. A weak dollar can fuel explosive growth, but comes with much higher risk. The real key isn't about choosing one over the other. It's about understanding the cycle, because the dollar will rise, and it will fall again and again. And every single movement carves a new chapter in the story of the global markets. The real question isn't whether the dollar is strong or weak today. It's whether you are prepared for when it inevitably shifts. The market rewards those who understand its rhythm and punishes those who ignore it. In the end, the dollar remains the world's greatest paradox. It's feared, trusted, hated, and worshipped all at the same time. It can bring prosperity and crisis in equal measure. It shapes nations, builds empires, and sometimes it destroys them. It dictates the fate of companies and the dreams of individuals. And every time it moves, even by a fraction of a cent, it whispers a message to the stock market. A message of risk, of opportunity, of warning. Because in the world of finance, nothing moves in isolation. The dollar leads and the markets follow. Those who learn to read its movements don't just survive, they thrive. And so the story continues, quietly and endlessly, always waiting for the next rise, the next fall, the next moment when the world stops. Looks at the screen and asks once again, what will the dollar do next? And what does it mean for all of us? Thanks for watching. If you found this helpful, don't forget to like and subscribe for more insights into how the markets really work.